This tutorial is a project of nonprofitaccountingbasics.org, a free resource developed by the Greater Washington Society of CPAs Educational Foundation. Our goal is to encourage accuracy and accountability to help smaller nonprofits successfully manage and sustain their organizations.
I'm Patty O'Malley of Rubino & Company, and today I'm going to talk to you about preparing financial statements by an accountant in public practice. Some of you may be sitting in your office thinking, well, my accountant already prepares my financial statements, or perhaps your auditor. But I'm going to talk about a new statement issued by the American Institute of Certified Public Accountants in October of 2014. This is the Statement on Standards for Accounting and Review Services, Clarification and Recodification, or SSARS, and specifically it's Statement 21 and Section 70. The statement replaces previous statements, with the exception of SSARS 14, which is the compilation of pro forma financial information. The effective date is for the preparation of financial statements for periods ending on or after December 15, 2015, but early implementation is permitted. This means that the service is available to you at this time. The statement addresses financial statements that are going to be prepared by an accountant in public practice. Public practice means a CPA or a CPA firm, and so you will have to engage those individuals to prepare financial statements if you want this service. The preparation of financial statements is also defined by what does not apply. So if you have an audit, review, or compilation, it will not apply. Also, if the statements are solely for the submission to taxing authorities, for inclusion in personal financial statements, in conjunction with litigation services, or in conjunction with business valuation services, it will not apply. The start of the engagement is defining the terms of what will be done, and that needs to be in writing in a letter that is signed by both parties, the CPA or CPA firm and your entity. The terms of the engagement must include the following: the objective of the engagement, and that's going to include the preparation of financial statements in accordance with the financial reporting framework for the entity, and I'll discuss that in a little bit. But they must also be prepared in accordance with the SSARS guidance and also the AICPA Code of Professional Conduct. There are several responsibilities of management that are included in the letter. For example, the prevention and detection of fraud are management's responsibility. You should have the procedures and controls in place to make the likelihood of fraud minimal. You are also responsible for ensuring the entity complies with the laws and regulations that apply to it or its activities. The accuracy and completeness of the records, documentation, and explanations that are given to the accountant are also included under these responsibilities, including significant judgments. And finally, you need to provide the accountant with documentation and other information that's relevant to the preparation and presentation of the financial statements, provide additional information if it's requested, and have unrestricted access to your personnel if the accountant requests it in their attempt to put together the proper statements for your entity. Management also agrees that each page of the financial statements will include a statement indicating that no assurance has been provided on the statements. So on the statement of financial position and on the statement of activities, the statement will appear. If management does not agree that this statement will be included, then a disclaimer will need to be issued that makes it clear that no assurance is provided. The responsibilities of the accountant go to those described under objectives for the engagement, and there are limitations that you need to be aware of. The accountant won't verify the accuracy or completeness of the information that's given to them by management. And further, they will not gather information for the purpose of expressing an opinion or a conclusion. There's no assurance given, and so that step is not necessary. The identification of the applicable financial framework goes to the basis of accounting being used by the entity. So for most nonprofits, that's going to be generally accepted accounting principles or GAAP. But many smaller nonprofits only have cash as an asset and no liabilities, and so the cash basis or the modified cash basis of accounting might be more applicable for them. In cases like that, the wording on each of the statements will change, and I'll talk about that in a minute. If there are departures that will be made from the financial statements from the applicable financial reporting framework, those will be identified and included within the engagement letter. The financial statements will be prepared using the records documents and other information provided by management, as I noted before. And on each page, at a minimum, the words "no assurances provided" will be included on each statement. So the statement of financial position and statement of activities. Your accountant may decide that they want a more robust description of that, but at a minimum, you should see that phrase. If management does not allow that statement, a disclaimer will be issued, or perhaps a compilation agreement should be performed instead. For special purpose frameworks, such as cash basis, a description on the financial reporting framework should be included on the face of the statements. So the statement of financial position may be something like the statement of assets, liabilities, changes in net assets, cash basis, or maybe you'll include it in a note to the financial statements. If the accountant assists management with significant judgments regarding amounts or disclosures included in the financial statements, the accountant has a requirement to discuss it with you as management so that you understand what the judgment is and what the consequences are for your financial statement. Management is responsible for accepting the financial statements, so it's important for you to understand what's included in them. If you are not sure, just keep asking questions until you feel comfortable. If the accountant becomes aware that your records are incomplete or inaccurate, they're going to come back to you and bring it to your attention, and they'll ask you to provide additional or corrected information to them. It's your responsibility to do that as opposed to theirs, because they're just preparing the statements for you. They're not looking at your accounting records per se. For known departures to the applicable reporting framework, there will be disclosure of those that make or result in material misstatements in the financial statements. It is appropriate, if you choose, to omit substantially all disclosures that are required by your financial reporting framework. And in instances like this, what happens is that the omission is disclosed, but it's on each individual statement. So the statement of financial position or the statement of activities will have the disclosure that says that the omission has taken place, but also what possible effects could be for the user or readers. If the accountant becomes aware that the omission of substantially all disclosures is being made just to mislead the users of the statement, well, then the accountant needs to withdraw and the statement should not be prepared. And just a few miscellaneous items, some of which you've already seen, but they're fairly important. The first is that because there is no attest function, the accountant does not need to be independent of the organization to prepare your financial statements. The next two are not new. The accountant is not required to verify the accuracy or completeness of the information. This is important for management and the board because they need to understand that the transactions of the organization have not been tested in any way. And so there's not going to be an opinion given on the statements. And then finally, this particular statement can be used for other purposes. So if a statement's needed on specific elements or accounts within the financial statements, that can be done. If you have a schedule of supplemental information, you may want to use this to to provide a presentation that's in conformity with your financial reporting format. And you can also look at prospective financial information for budgets or projections. This is just a brief summary of the provisions of the new standard, and we hope you find them helpful.